Hello everyone, this is Andrew McNair from Swan Capital with an educational update on the recent drop in the stock market and what it means to investors like yourself. First, let's discuss the history leading up to the drop in the stock market. The new year began with investors feeling very optimistic. Indexes were continuing to rise from 2017's, hitting record highs. In January, the S&P 500's success story continued with the best performance since 1997. However, on February 1st, stocks began to drop. The Dow, the S&P 500, each losing 4%. However, within the day of declines, the stocks were showing improvements. So what happened? Market fluctuations can certainly be nerve-wracking, but we're here to help you better understand how the market works, what the fluctuations mean, and how to apply them to your circumstance. So let's take a few steps back to gain a wider perspective of what happened. Naturally, when investors watch markets fall, rise, or fluctuate, they begin wondering, what's going on? What's causing these fluctuations, especially the ones that are going down? And at first glance, this one appears to be hard to diagnose. The sell-off from February 5th through the 6th had no obvious causes. News about the economy was essentially positive. There was nothing in the news that appeared to have the power to influence markets so negatively. So what happened in early February appears to have stemmed from emotion-based investing. Investors also overused computer-generated trading, which puts in place of artificial sell-off points to sell off at certain metrics. And then you have labor reports also showing wages were increasing more than expected, which convinced many investors that were scared that inflation rates would rise. Higher wages can sometimes mean businesses raise prices to pay for those higher labor costs, but not all the time. Then worries about inflation and interest rates are only part of the picture. The big issue for many investors may be volatility, and volatility is normal. See, consider these facts. The S&P 500 has undergone an average annual correction of 14% per year since 1980. 2017, however, was different. Markets were unusually calm. We've been blessed, fluctuating only about 3%. Prior to the February market drop, the S&P 500 went more than 400 days without losing more than 5%. That's the best streak since the 1950s. Now, reports showed the Dow dropping 1,175 points on February 6th, the highest decline in history. While that's a factual statement and great headline, the larger indexes, the less significant raw numbers are compared to percentages. See, that 1,175 points doesn't mean the same in an index of 25,000 points compared to one that was 10,000 points. See, look at percentages, which provide a more accurate reflection of the market, not numbers. Remember this. Yes, the S&P 500 did fall 4% on February 5th, but the next day it gained 1.7%. If you look at the S&P 500's worst 15 days, when it lost an average of 8%, if you look at that, but looking at the longer view, in 13 of those cases, stocks were back up 12 months later, an average of 21%. Here's what you need to keep in mind. Even when stocks drop, they eventually turn around and post positive returns. Let's go back to the last market correction. In August 2011, the S&P 500 lost 6% in one day. Europe was facing huge debt crises. The United States here at home had its AAA credit rating downgraded. Markets were shaky at best. Investors were obviously nervous. The temptation back then was to leave the market. However, staying invested obviously paid off. A year later, the S&P 500 gained more than 25%. So what can we learn from this recent market fluctuation? It's that overall, the short term, markets trade on fear, greed, and anxiety, Over the long term, though, it's sound fundamentals that drive the market. If you look at the economy and if you look at business fundamentals. The good news is there's great indicators out there. 200,000 jobs were added in January, which is higher than expectations. Average hourly wages rose, which produced 2.9% growth over the last previous 12 months, the largest since 2008 to 2009. The majority of the S&P 500 companies who reported fourth quarter earnings passed all the estimates they had. If you look at in the service industry, the non-manufacturing index hit the highest level since 2005. If you look at here at home, your personal income as consumers have increased and consumer spending has increased. Market fluctuations have maybe a difficult lesson. As investors, we may be still wondering whether inflation will go up or whether the Fed will raise interest rates. The reality is market volatility may continue. Last year was uncharacteristically calm, and we've been accustomed and very blessed with that low volatility. But the fact is the market rarely follows a smooth, straight line. On a positive note, if there's any degree of volatility here to stay, it provides new market opportunities that will come available. See, more economic growth will ultimately be a tailwind for equities, not a headwind. We encourage you to maintain your focus on long-term goals. Don't allow emotions or the news or headlines to sidetrack you. We want you to be comfortable and confident in your investment decisions. Now, if your investment objectives have changed in the last 30 days, call us. Let's talk about it. Let's have a review. We're here to provide you with clarity, perspective, and support. We appreciate the confidence you place in our abilities. Consider it really a privilege to be good stewards of the assets you entrust to us. Once again, this is Andrew McNair signing off for this period, this video at Swan Capital.